Okay guys, so I'm creating this video today because some people seem to have some trouble wrapping their minds around the impact on the financial statements if we do not make adjusting entries. So keep in mind that we make journal entries throughout the accounting period for typical things just like day-to-day purchases and sales and things like that. But at the end of the accounting period, we make these things called adjustments for a variety of reasons that are covered in the book. Sometimes it's just not practical to make the journal entries every day. For example, we make the accumulated depreciation entry at the end of the accounting period. If we wanted to, we could figure out what the annual depreciation expense is and divide that by 365 and record it every single day of the year, but that's not practical. It's kind of just a waste of time. So we just wait until the end and we make these things called adjusting entries that are all going to be dated on the last day of the accounting period. And if we're a calendar year business with a year-long accounting period, then that would be on December 31st. So anyways, this is an exhibit that can be found in a lot of different textbooks here, and it talks about I don't know, I think really it does a decent job trying to explain it, but I think what might be better is if I show you just an example problem here. So let me bring this little fella over. And let's take a look here. So this is something that I typically work with my seated sections, and I'm just going to put this together here on the screen and show you. And we'll talk about each one of these, what's going on, why we need to make a adjusting journal entry, what it looks like, and then what the impact would be if we did not make it. So for the first one, it says the company received its electric bill on December 20th for $225, but we're not going to pay it until the next accounting period. So we have a bill, we've already consumed the electricity, we know how much the bill is, but we're not going to pay it just yet. So what we have here is this $225 utilities expense that we need to record, but we can't credit cash because we have not actually paid it yet. Okay, doesn't that make sense? We haven't cut a check yet. We're not going to cut it until the beginning of the next accounting period. So we have an increase in a liability and we have an increase in an expense. If we forgot to make this adjusting journal entry, then that means that our payable here, this should have happened. Our payable just went up by $225. So if we did not make this, that means our liabilities would be understated, meaning less than what they should have been. Okay, so let's just say beforehand we didn't have any utilities payable. After this adjusting entry, we can see that the proper balance should be $225. So if we forgot to make that entry, then that means that our utilities payable would be understated. And our equity would be overstated because we would have not reduced it with this $225 expense. And remember that expenses hurt our equity. So down here, we can see here that our liability would be understated, equity would be overstated. And then it says specific category of account on the income statement, and that's talking about the expense there. We had an expense, and if we understate an expense, we overstate our equity, right? Because remember, expenses and equity have opposite impact expenses and revenues have the opposite impact on equity. Revenues increase equity and expenses decrease it. So this problem here, it kind of forces you to maybe overthink it a little bit, perhaps, but just think, like, if we didn't record that entry there, we would have neglected to record an expense that we incurred, and we would have forgotten to have recorded a liability that we should have. Now for this next one here, it says that we paid a 9-month boat insurance policy on November 1st for $9,000. We recorded a debit to prepaid insurance. So originally we would have recorded this with a debit to prepaid insurance and a credit to cash for $9,000. But what it's asking us for now is how much of this have we used? We have to look at these circumstances and think about, okay, we bought that on November 1st. We had it for all of November and all of December. Well, it was for 9 months, and it was $9,000. So if we say 9,000 divided by 9 months, that gives us $1,000 per month, and we had all of November and all of December. So we're looking at $2,000, and we used $2,000 of that insurance expense. insurance is consumed with the passage of time. So what we have here is a reduction in this asset. It went down here, this prepaid asset, or prepaid insurance, which is an asset. It went down, and it went down as we consumed it with the passage of time. And so it left the balance sheet where it was an asset, or at least a portion of it did, and it's finding its way to the income statement where it's an expense. So this reduced an asset, and this reduced equity. Since this reduced equity, if we forgot to make this entry, that means that our equity would be overstated. And our assets would also be overstated if we forgot to make this, because that means we would have not reduced them. Okay? So we can go back here, and you can pause the screen at any time if you want to go back and revisit these. See here, it says as of December 31st, we had earned $2,000 of charter revenue. We just hadn't gotten around to recording it. We've done the work, we just haven't entered it into our accounting system, and that's known as an accrued revenue. And so when that's the case, we record this just like we do anytime we have a sale that we're going to receive payment for later. We have an increase in equity and an increase in that asset. And in this case, they just gave us the number of $2,000. If we forgot to record this, we would have failed to record $2,000 that we earned a revenue. And accounts receivable went up by $2,000. So if we forgot to make this entry, our accounts receivable would be understated, and would our revenue. Okay? Both of those there. And of course, the equity account here was a revenue account that would be understated. Now on this next one, it says we purchased a boat for $44,500. It says it has a residual value of $4,500, and it's going to last us for 5 years. So let's go down here and take a look. So remember, you take the cost, you subtract out the residual or salvage value or resale value. Those all are synonyms. And then we divide it by how long we plan on using it. So we're going to say $40,000 divided by 5 years. So that means we're going to have depreciation of $8,000 a year. Remember, with the depreciation entry, we always debit depreciation expense and credit accumulated depreciation. And it was for $8,000. Okay, and we used a process known as a straight line method of depreciation. And then lastly, it leaves us with the fact that we received $8,000 of a prepayment for a deep sea charter fishing tour to take place in December. And so we were paid in advance. Originally, we would have recorded that as unearned revenue would have been credited, and cash would have been debited. Okay, because we received cash and we hadn't done any work. Now we've done the work, so we reduce that liability here by debiting unearned revenue, and we're showing that we earned it. Okay, so if we forget to make this, equity would be, this shows an $8,000 increase in equity. So if we forgot to make this, equity would be understated. Okay, and unearned revenue is a liability. If we forgot to make this, that means that the liabilities would be overstated, right? So let's go down here, take a look. Boom, perfect. Okay, so if you need to, pause the screen, take a look at this, and with a little common sense, just what it's asking you down here to think about is if we forgot to make this, what would the impact on the financial statements be? And I think about 70% of Walmart's total assets are fixed assets. So when we're talking about something like depreciation expense, this can be a huge, ginormous number. And if we forget to make an adjusting journal entry for something like this, the impacts can be massive. Okay, so it's really important that we do not forget to make these adjusting journal entries. In practice, a lot of times accountants go back and look at the adjusting journal entries that were made the year before just to double check to make sure that maybe they haven't forgotten to do something. A lot of times businesses will have similar adjusting journal entries from year to year. I hope that helps. Please let me know if you have any questions, and have a wonderful weekend.